Good afternoon. It's a pleasure to be here. I've been traveling in Asia this week and last week I was in Sydney. It's taken the toll on my voice a little bit, so hopefully it will hold out. But it's great to be able to talk to you about impacts and world research in person. So for the 5 years we've been producing the Impacts Global Research Programme, change really has been the constant, and certainly it only feels like the last 2 years in particular that's only been accelerating, characterised by geopolitical, health and environmental change. And it's through this lens that we look at the world of global real estate and the challenges and opportunities that it faces. Now, each year we have a theme for our global research programme. This year, with the world opening up after the pandemic, the theme is Reconnect. And specifically, we ask the question, what is the role of real estate in helping people and businesses connect and thrive in today's world? Now, before I turn to some of the long-term trends that we focus on in the programme, I'm going to talk a little bit about some of the short-term challenges that we face. We're all acutely aware of the economic headwinds that we're seeing impact the global economy. So I'll touch on that briefly first. So in terms of sort of the global economic picture, a couple of things at play. So first we had an inflation shock. So as the world opened up, we saw prices appreciate very rapidly. That's been compounded by the war in Ukraine, and you can see how that's impacted consumer price inflation, as this chart shows in key markets. More recently, we've seen an interest rate shock. So central banks have tightened their monetary policy. We've seen base rates move up in response, and here you can see how they've moved from the historic lows that we'd been enjoying. And certainly there's a realization now that the combination of these factors is going to weigh on global growth in the near term. Now, the IMF have just put out new global economic forecasts just this month. And this chart shows the forecast they put out this month and the same forecasts of April of this year. And you can see how quickly these forecasts have been downgraded. The global picture is that global growth is expected to slow to 2.7% next year. That will actually be the slowest expansion of the global economy since 2001, excluding the financial crisis and the pandemic. And you can see really no market is excluded in terms of that impact. Now, one of the big drivers of all this is, of course, inflation. And that's playing out differently in different parts of the world. And this just picks out a couple of countries to see how the inflation picture is made up. So taking Germany as a nice example for Europe, energy prices, the big driver of inflation here, of course, being impacted particularly by the war in Ukraine. In the US, slightly different picture, much more about other items, so things such as housing costs, wage growth, and also things like domestic good prices, which are actually one area where inflation is starting to slow. So this is good news. And certainly the consensus is that inflation is already peaking in the US. Europe perhaps isn't too far behind. And the focus will increasingly shift to the rate at which inflation declines. And recent trends across supply chains, I'll talk about that in a bit, commodity prices suggest that inflation will come down at a decent pace next year. I think if you layer on top of that softening economic growth, softening labour markets, again, that will help to bring down prices in line with demand. Now, another reason that inflation will come down is because, of course, all the rapid interest rate rises that we've seen from central banks. This chart shows a count of rate increases among global central banks. The orange line shows where the last move was an increase, the blue line where it was a particularly large increase, and you can see how sharp that trend has been in the last couple of months. Now, recent communications from central banks is that these rises are likely to continue. There's a real drive to bring the headline rate of inflation back to a target of around 2% to avoid it becoming entrenched. And really, they're willing to do this at any economic cost. Now, what is the impact on real estate? Well, starting with the global picture, we've seen a big deterioration in investor sentiment. So the blue line shows global sentiment. The orange bars show year-on-year change in global real estate investment volumes, and you can see that big bounce back post-pandemic and then how that's turned negative. Certainly we're seeing many investors currently adopt a sort of wait-and-see approach. Of course, the higher interest rate environment putting pressure on pricing. The other concern is the impact of weaker economic growth, and this chart shows the correlation between GDP and all property returns for the UK. It shows how the two are very closely correlated. Occupier demand has held up relatively well so far, so the question is, will that continue? And certainly that could start to impact rental growth over the near term if that does weaken. I mean, so nonetheless, that's the current picture, but property is a long-term play. And we really need to kind of cut through the near-term velocity and look towards the horizon. This brings me back to our global theme of reconnect and the changing role that property plays both today and in the future. So reconnections are happening in three key ways. So firstly, faces or people. People are coming together again. They have new priorities as they do so. Secondly, spaces or buildings. They've had to respond to these new behaviours and increasingly new environmental demands. And finally, places are cities. They've had their very existence tested over the last few years. What does the future hold for them? So starting with faces and specifically workforces. For many, it's been more than 2, almost 3 years now of working flexibly from home and the office. Employees have very high expectations now of flexibility. But clearly, as the world has opened up, employers are keen to bring their teams back to the offices, to build relationships and promote company culture. Now, this is feeding through to office utilisation levels, and this is a really interesting chart. It shows average office utilisation across different world cities. You've got almost 100% in much of mainland China, through to well under 50% in parts of the US and UK. Singapore, right in the middle at 50%. Question from all of this, sort of where does this leave the office? Where does the office go from here? I'll take you through that in a moment, but first I'll just talk to you about one of the other longer term drivers of certainly demand and occupier requirements, and that's demographic challenges. And specifically aging of global working-aged populations. So high-income countries saw working-age populations grow by 6% in the last 2 decades. They're forecast to fall by 4% in the next 2. Compare that to Singapore, very strong growth in the last 2 decades, forecast to see a decline. Compare that again to somewhere like Australia, where I just was. Actually comparatively stronger sustained growth, albeit still slowing. And compare that again to the likes of China, where the sort of legacy of the one-child policy, we're seeing declining fertility rates and forecast falls there. Even India, which has seen pretty spectacular growth, set to slow to some extent. And certainly if you're looking through to the 2030s and 40s, that starts to impact where corporates might look to locate, to tap into the depths and breadth of talent that they need. And I think it also means that the office becomes really even more important as a place to attract and retain talent. And this leads me nicely onto spaces and specifically offices. So a couple of things the office needs to do. So first of all, it needs to prove its worth as a place that can contribute to productivity and innovation. So that means better and inclusive design. It means best in class, a shift to the best located office space. Flexible space is going to become more important, both as a solution for corporates, but also that kind of midpoint between home and the office. And I think crucially, offices need to stay green to be relevant. Now, this environmental challenge is huge. We're all aware of it. The UN has set an objective of a carbon neutral world by 2050. And as a contributor to 40% of global carbon emissions, the built environment has to be at the heart of the solution. So we've done lots of analysis into this at a global level. Starting with cities, a lot of cities are actually leading the way in this respect and have more ambitious climate targets than even the countries in which they're located. This map shows cities around the world. The darker the green dot, the more ambitious their climate target. European cities do well here, to some extent North American cities. But it isn't just at a country level. Cities are also leading the way to... We know that occupiers investors are also demanding green offices in order to meet their ESG targets. So one way we've seen this develop at an office level is the rise of green certified office buildings. So this chart, this map, very actually similar in terms of distribution to the one we just looked at. We've analysed the global distribution of LEED, BREEAM and WELL certified office buildings. And there is a clear correlation. So particular sort of hubs within Europe, North America, and the big sort of gateway cities in Asia as well. No surprise there, but that only tells half the story. If we look at share of total office stock, even in the top 20 markets, on average, only 28% of stock is certified. And that means 70% of stock either needs to be retrofitted or repurposed in the coming years to meet those environmental standards. And this is a significant challenge. How that pans out varies around the world. As a proportion of total office stock, those are the top markets on the left there, sort of mid-level. You've got indeed Singapore in there. And at the lower end, a lot of sort of more historic cities grappling with older stock, a real challenge there. A bit of a sort of warning from the future actually is New York, a really interesting one. Grade A vacancy stands at 18%, up to 25% in some areas. Tenants very much shifting to best in class in that sort of fight to quality. And that leaves large swathes sort of no longer fit for purpose, particularly midtown, downtown. And that's in spite of having a very high share of certified stock. And some of these are being renovated, some are being converted to residential, but of course not all are suitable because of very deep floor plates. This is a real challenge and certainly already playing out in that market. So turning to places now, we've seen the very connections between cities altered in the wake of the pandemic. Supply chains are a good example of this. They link places around the world. They're really kind of the lifeblood of the global economy. We got used to images like these, or this looks very much like Singapore, of ports becoming congested after the pandemic. But supply chains challenges aren't new. They've only been building in recent years. So first we saw tariffs in the wake of the US-China trade war. More recently, of course, geopolitical instability associated with the war in Ukraine. And that's led manufacturers to really kind of reassess their supply chains from just in time to just in case. And in turn, that means more demand for warehousing space. So low, and in turn, we're seeing very, very low logistics vacancy rates around the world. If you layer on top of that increasing demands from corporates and consumers for better ESG performance from manufacturers, suddenly you're heading towards a complete rethink of global supply chains. So this is two charts here. On the left, you've got the global supply chain pressure index. You can see it move to a peak in May of this year. It has actually fallen a little bit, sign that in the short term, we're seeing some of those supply chain pressures start to ease. On the right, you've got accumulations of inventory, and you can see how that's, again, really peaked as manufacturers have been using a sort of just-in-case approach. That might start to lead to some discounting, particularly in the likes of the US, where this trend is more advanced. Good news, again, for the likes of the inflation story that I was talking about. But if the short term is just in case, the medium term is really about nearshoring. So here we have mentions of nearshoring in annual reports over the last 2 decades. And you can see how that spiked after the pandemic, and then more recently that trend continues. So this is something that's not going away. Manufacturers and organisations are really thinking about this. We spent some time exploring this potential nearshoring shift. We've developed an index of location preferences on 2 scenarios. So the first one is the sort of traditional offshoring model where it's all about cheap labour, so economics dominates. The second scenario is much more balanced, so actually resilience matters more, ESG credentials of a location, the wider sort of business environment, how you treat your staff, etc. So this map shows that potential shift. Green shows countries that will benefit from that nearshoring shift. So in an offshoring strategy, you've got your sort of Thailand, Taiwan, India, China, Malaysia, so very much cost-driven. In a nearshoring strategy, top of the list, you've got places in Europe, even the UK. Taiwan, interestingly, appears in both. And this starts to potentially have big repercussions for logistics, particularly in developed markets. A sector already seeing very strong growth from occupiers. So in the US, average vacancy rates stand at 4%, just a notch up from the historic lows of 3.9% we saw very recently. And some coastal sites are sold out. In Europe, take-up's expected to finish this year 20% above the 5-year average. And that's driving up demand for warehousing and in turn warehousing costs. So this chart's really interesting, 52 global markets looking at rents, taxes, service charges for warehouse occupiers in prime warehousing space. So top of the list, you've got London, Hong Kong, Tokyo, Sydney. But the interesting thing are the grey dots, which is the growth in those costs in the last year. UK markets very strong, so too the US. Incredible growth in some markets, 30, 40%. So on the subject around sort of e-commerce, another driver of all of this, again, two charts for you here. What's been driving that? Well, we saw, this shows quite a close correlation between e-commerce penetration on the left here and mobility, an example from the UK. But clearly, as we had the lockdowns, you saw a big spike in e-commerce usage. Now, to some extent, that's rolled back as the world has opened up, but certain sectors are sticking. So things like clothing, electronics, department stores. So that's going to sustain that continued growth in e-commerce. And that's just in developed markets. In developing markets, there's still plenty more to come. So I guess the question here is, where does this leave logistics going forward? Will its very strong run continue? I think to some extent, yes. Vacancy rates are at record lows in many parts of the world. Taking the UK as an example, average vacancy rates are at 3%. Historically, it's taken vacancy rates to get to reach 12% before rental growth stopped. So we're a long, long way off that. Supply remains very tight. Higher build costs are going to continue to weigh on that further. So too demand from competing demand from the likes of data centres. Now clearly, there's some price discovery to come from an investor point of view in a higher interest rate environment, and there's got to be something to give there. But nonetheless, those sort of solid fundamentals will remain, both that e-commerce story in developing markets, but also that nearshoring story in developed markets. So finally, onto places, the last part of places, I'll talk about cities. And I think in the pandemic, a lot of people said that the city is dead. People were moving out to the suburbs. It was definitely a watershed moment for cities. But I think what we've realised very quickly is that the city lives on. And we're seeing that in all sorts of ways. I think most interestingly through our analysis of global residential markets and cities, 20 out of the 30 cities we monitor saw positive price growth in the first half of this year. And we've seen the strongest average rental growth in cities in the last 7 years, so pretty remarkable. And that's really testament to the resilience of cities. And again, we've created an index on this, comparing different global cities. We've done that across a couple of key measures. So we've looked at city economic strength, we've looked at their knowledge economy and technology sectors, we've looked at their ESG credentials, and we've looked at their real estate industries. And we compared that both in 2016 and in 2021. So this is the overall ranking. New York and London top the list, positions unchanged. A lot of mid-tier US cities on the rise, benefiting over that period. Singapore in 12th, down very slightly. Not so much it's failing in any area, more that others have moved more quickly over the same period, but still certainly strong position. I think the big story, particularly around economic resilience, is that big is beautiful. And the top 10 cities in the index account for nearly 18% of global economic output. Now, this chart cross-tabs the real estate pillar of our index and the economic strength pillar of our index. And you can see there's a clear correlation between the two. And no surprise, our top 5 cities are in the top right-hand quadrant. The other, I guess, interesting story, certainly if we look over the last 5 years or the period since 2016, is the rise of those Chinese cities, mainland Chinese cities, rising up the rankings. Again, in primarily economic terms, really moving up very quickly. Interesting, though, that only Shanghai appears in the top 20, and that's because Chinese cities benchmark relatively poorly on ESG credentials and economic risk factors. The other really interesting story to come out of this is that smaller cities are punching well above their weight on a global stage. We see Scandinavian cities do very well around their ESG credentials. Picking just one sort of sub-metric, which is the use of renewables, you've got the likes of Reykjavik, Oslo, Stockholm, Copenhagen performing very well. The other area around smaller cities is the ability to tap into those high-growth knowledge industries. So Boston's a really nice example here. Comparatively small by US standards, only just in the top 25 by US city standards, but is comfortably in the top 10 of our index, and that's because of its life sciences sector, its tech sector, its strong higher education sector as well. And just to talk briefly about a couple of the interesting movers and shakers. So Berlin moved into the top 10 in the index. It saw the most real estate investment in Europe last year. Again, a big tech sector, a big talent magnet, more affordable by European standards, although costs are rising. I talked briefly about the sort of mid-tier US cities. So we saw Houston, Phoenix, Dallas, Seattle, all moving up the rankings, attracted by lower costs, again, of living, attractiveness post-pandemic. And some of those interesting European centres, so Copenhagen up 11, Barcelona up incredible 140 places, also benefiting from things like digital nomads, so remote workers working flexibly in Europe, boosting that market. So obviously lots there, and to sort of draw everything together and sort of bring it back to my original question, what is the role of real estate in today's world? Well, change has been building, as we've heard, and it's only accelerated in the last 2 years. And property needs to work harder to remain relevant to occupiers, and investors are taking note too. We've heard how forces are coming together to alter the flows of people and trade, and in turn the hierarchy of cities. And I think big cities have something to learn from smaller cities in that respect. And finally, E, S and G. Property accounts for 40% of global carbon emissions. Property's therefore at the heart of the problem and the solution. That means rapid adjustment is needed. But in a world that's reopening in new ways, the S and the G, social and governance, matters more than ever too. So that concludes my presentation. I don't know if we'll take questions now or at the end. Should pass to Alan.
Yeah, we can take the questions now.
Sharon.
Anybody has any questions for Paul? Oh, yes.
I'm from the Madrid office. I just landed. So my question is regarding the trends that I saw on the flex office spaces that is a kind of trend overall worldwide. Does it happen similar in Europe as in Asia? That companies are like betting to be on flex space rather than the conventional space?
I think it's a sort of tool in the arsenal. It's part of the strategy, and I think it's an increasing recognition that it can sort of help diversify occupier solutions. Not a lot of data yet in terms of how it's playing out in terms of individual markets.
Okay, we also have some participants online via Teams who have been attending this. Feel free to post your questions in the chat box if you do have any. But in the meantime, maybe I will ask Paul. I saw your slide earlier on about e-commerce going back to pre-pandemic levels. But I would have thought that during the pandemic, actually e-commerce would thrive.
Yeah, so I mean, clearly there was a huge boost in the pandemic itself. I think the point was the extent to which that's reverted to the pre-pandemic trend, and it varies by sectors. So some sectors have sort of stuck at the higher rate of growth, whereas others, where people are more willing to go back and experience the sort of physical retail element, have reverted to the pre-pandemic trend. So clearly the pandemic was a huge boost to e-commerce.
So now it's doing even better than before, or is it?
It varies by sector. I think that's the story. Yeah.
Yes.
Because it has been very positive so far. Like, vacancy rates, the rents are increasing, but we do see a lot of tenants telling us that probably there will be recession next year, or due to interest rate, there is a lot of challenges. How does that impact the economy in general?
Yeah, I mean that is the big question, and occupier demand has held up relatively well so far. I think the question mark is the extent to which higher costs and rising rates do impact that occupier story, and maybe just starting to see the beginnings of that. I think that will dictate the extent to which the market, the route the market takes next year. Yeah, good question. So we've done some analysis at a European level, and the view is that there's a sort of a net 10% less space required, because clearly if people are coming in sort of flexibly, you still need a certain amount of space set aside. I think it's not a clear-cut story globally. We see the US has lagged, and there's a kind of counterpart story to that, which is the sort of residential story, and we've done analysis previously of some of the drivers, and you can see the correlation with sort of the home environment. And cities, for example, with bigger homes or longer commutes are more likely to stick in terms of that work from home piece. But again, essentially that's where that co-working thing comes in as a sort of mid sort of stop off as an opportunity as well.
We have a question from James online. What was the biggest surprise you had when conducting the research?
Ooh, interesting question. I guess some of the city results are always interesting, and to some extent we'd expected to see those smaller cities on the rise. I think what was particularly interesting is those sort of mid-tier group that's moved up the rankings a bit under the radar. That's one of the standouts. I didn't even talk about it. There's a whole sort of thread around the metaverse as well, which is an interesting sort of area that I had to educate myself on, which certainly emerging but has huge potential to disrupt the industry, and maybe in the same way that the internet has done so far. So if we're looking very long term, that's certainly one to watch.
And in terms of the resilient list of top cities, how does one progress further up to the top spot?
Yeah, I think the big sort of differentiator has been that ESG component, and it does, it's a very different story if you just look at economic strength, because you get the big cities, but investors and occupiers need more than that. It's ambitious ESG targets that people are actually acting on. It's equality in the workforce. It's a whole spectrum of things, but things like that need to happen.
Any questions from the floor? Okay, if not, please feel free to direct, one-on-one questions or find requests from while he's still here this Wednesday. Okay, can we just thank Paul for his time? And now we'll just get Alan to kind of share on the local market perspective. Alan, all yours.
Okay. Good afternoon, everyone. Okay, I'll just talk about the office market and the near-term outlook. This with regards to two driving forces that's going to impact the Singapore market, office market. One is ESG and the other is the economy, and how it will impact rents and prices. I had this disclaimer because I thought this was an external presentation, but anyway. Okay, so we have this profile for those in the commercial leasing sector. This is from your deck, and rents went up 0.4% in third quarter, quarter-on-quarter. Now, interestingly, although the URA just released last week that their stats for the third Q, stating that rents went up 2.4% quarter-on-quarter for offices, but that's overall. There are Category 1 office buildings, which is similar to our Grade A. If you, I'm not showing it here, but the rental profile, it's the same as our overall Grade A. That means, say, the 950 there, if we have a time series, it actually tracks it pretty well, or we track the URA Category 1 rents pretty well. And Category 1 rents in third quarter of this year went up just 0.9%. So we are not that far off from URA's number. I think some of our competitors will say, hey, we are right, we got 2.4% increase similar to URA, but that's not Category 1. And Category 1, by URA's definition, is CBD, similar to our CBD Grade A. New buildings with reasonable sized floor plates. And theirs is standing at about $10.50 or thereabouts. Ours is at $9.50 overall. Right. So, sorry, we have 0.3% increase, right? And it's slowing. Despite what the market is saying, our peers are saying, I don't think that we are in any condition to ask for rents that's going to increase 1% or more quarter on quarter. Right, so the AAA has been rising more than AA and single A, and I will explain later why the AAA will be the place to be, market rent wise, and but not necessarily price increases. Right. Capital values, we got this from our valuation team, Cynthia's team, appraised values, hardly any transactions, but every quarter we will ask them, what do you think, how would they value Asia Square on a dollar per square feet basis, or ORQ, OFC, Ocean Financial Center, and it's going up. But you know, if you go to Suntec City, it's 3,009 for the strata. These are institutional grade AAA buildings that easily goes, quantum bite size wise is over $1 billion. So it falls out of the sweet spot of the high net worth individuals who have a budget of between, let's say, anything less than 500 million or 400 million. That's where the sweet spot is for investment sales in office buildings. And of course, they are not yield driven, because in today's environment, in global economic uncertainty, we see the set of buyers being increasingly, or the subset of buyers being increasingly dominated by buyers who are not economically driven. So interest rates don't affect them. Together with this thing called the Common Reporting Standards, where real estate is not covered, what it means is if you buy real estate and you take no loan, there's no way to track. I mean, you cannot, central banks from other countries can't write here to the Singapore government and require or request the banks here to furnish information about who the owners of the real estate are, because they can only do it for banks. So it's a bank to bank, and if you don't take a loan, there's no link back to the bank. So those are up there, all right, in the stratosphere. But the yield is about 3 to 3.5%. That's why hardly any transactions are taking place in the institutional grade space. I think the private equity people will know you have negative carry from just looking at bare numbers. Even if you try to value add the building, it's going to be very difficult when you are looking at non-recourse loans on your office purchase, and it's 3.5 or even more today. So very, very difficult. more so for conservation shop houses, where the yield today is less than 1%. But I am not so much concerned about the yield for conservation shop houses, because conservation shop houses are increasingly viewed as an art piece, and art has no yield, right? Similarly, gold has no yield. So, okay, Paul had talked about this, somehow this moved, but we see major downward revisions. Paul had alluded to this, but in graphical format. But this is from this is a table taken from the IMF, and we see that the Eurozone, especially Germany, Italy, and UK, have seen major downward revisions in the GDP for this year. And China, I think 4.4 seems like a tall order. It may even go below that. And what has been interesting is, if you put $1 in the MSCI for China 30 years ago, today it's still $1. It went back to square one. So it makes a mockery of what happens if you try to derive the WACC, or the cost of equity, in your discount rate using the long-term market return. And if you benchmark it using the MSCI China index, it's zero, you know. That means market return is risk-free rate plus the beta times, cost of equity is risk-free rate plus the beta times market return minus risk-free rate. Market return in China is zero. If you less off the risk-free rate, it's negative times the beta. It doesn't make sense. So I think our business valuation colleagues may have to go and think about how we're going to resolve this thing, which Damodaran has somehow twisted around and found a way out. But you look at this, it's interesting. And then for Singapore, we're no longer going to see our new trend line growth will probably be below the last decade's trend line growth, GDP-wise. So we are heading into 2023. We have the real economy slowing. Then we have a funding famine for tech companies. The number of deals done have collapsed to pre-pandemic days, or rather below 2019. That's the top left. And then the number of unicorns, or rather the funding, that's the unicorn, that's the funding, it's gone back to about 219 days. And big tech is laying off, right? You know, Shopee, Meta, Google has ceased hiring, and for some of the growth departments, they have half the hiring. And in Singapore, we see inflation. So we have inflation and low growth, stagflation equals stagflation. Now, then we have ESG coming into the picture. With the help of Samuel from our facilities management side, I just did an off-the-envelope calculation this morning on what the impact of carbon taxes will be on our AAA, AA, and single A buildings, just based on carbon emission. So I plugged some of this number for AAA using Asia Square Tower 1, which has about 171 kilowatt hours per square meter per annum, sort of consumption of power. And then there's a conversion factor to CO2 emission. Doesn't add that much so far. By 2027, you'll probably add about 3 cents per square feet per month to the conservancy charges. But then, if you go to the older buildings, the single A and the double A, we find that it starts to rise because they are less efficient in their power consumption. Now, this is just based on what they consume, right, for power. I've not included embedded carbon. Embedded carbon means all this stuff that you have in the construction of your building, the renovation of the office, and that would probably have to be priced in. Right? So I've not included commuting carbon footprint for the workers. So if you add everything in, I think you just have to lift this function up, right? I think it just has to go up. And this is for Asia. I mean, I just got it from Samuel. His numbers are real life 2021 power consumption from Asia Square. If I were to use the UK's CO2 emission, because it's a temperate country, this doubles, because they have heating to about 10 cents per square feet instead of more than double. 10 cents per square feet compared with our 3.5 cents here because we are in the tropics. And okay, one more thing is I have also assumed a carbon tax of $50 Sing dollars per ton. By 2027, the carbon tax rate in Singapore will range from 50 to 85. I'm just using the lower bound of 50, and we see this of cost increase. And other than this, at a corporate level, ESG is going to take on more of corporate resources because the need to comply with ESG requirements and standards is not only for multinational companies needing to comply with their home country standards. Local companies too, who are listed, will also have to comply with the MAS requirements. So compliance cost goes up. So we have costs here, costs there, ESG. And what would happen in 2023, I believe the ESG part framework would, or rather the pressure from the ESG side, is probably not going to be felt that much. It's more the recession of the economy. And so the economic slowdown and the tech slowdown is likely to continue next year. So it's going to weigh down on office demand, but on the bottom side, we have inflationary pressures, more so coming from labor and supply chain issues. So the raw materials, the supply of goods and services to office buildings, to any real estate will go up. Then relatively, but it's also being supported on the bottom side, bottom end of it, relatively low supply. And then lastly, but less felt in 2023, ESG compliance cost pressures. Now I've not put in one more factor here because it's not directly related to the office. What will factor or feature in very increasingly in the near term to medium term is rental costs for expats of your foreign workers. Between July and August, rents in the luxury segment of our residential market shot up by 17% month on month. So on the ground, what is happening is we're seeing, let's say, I give hypothetically, well, my agency contacts are telling me, say in February this year, rents were $3,400 for, say, a 2-bedroom apartment in the East Coast. Come June, it was $4,000. Today, it's $5,300. So that's the way things are going up. Now, if you look, is this going to affect office demand? It is, because how many workers are you going to bring in from overseas? It will affect. But that's so-called something that will come into this arrow on the top end to press it down. So working from home, is it viable if rents are so high? Not for this, not for foreigners. So Bloomberg has a Bloomberg has a table of 6 up and coming tech cities around the world. And in Asia, Kuala Lumpur was mentioned. Right. The other cities are Rio de Janeiro, Mexico City, Lisbon, Dubai, and Bangalore. Now, why KL? KL is a city that has been mentioned in many conversations I had with people in the tech industry to start up the unicorns. They outsource to people in KL. And where do they get the talent? The Malaysians got educated in Singapore in the tech sector. They work a few years here. They say, why don't I go back to KL with my contacts, outsource? So something they can do for, say, an NFT design, graphic designer for NFT, a 1-week project, 5,000 Sing if you do it here. You go to KL, you charge you 3,000. And in fact, cities or small towns like Kuching has been mentioned. So the tech world means that you need not necessarily have to be in the CBD of an office of a big city. But what we have here in Singapore, the saving grace is relatively low supply. Okay. So what would happen in rents if no war in Ukraine, no pandemic, and because of no pandemic, no war, no inflation, still low inflation, and that means low interest rates. Grade A, overall A means A, triple A, double A, single A. This is the profile of rentals that we forecast till the year 2028. How is this done? This is forecasting. You can find this in Excel actually. It's a machine learning forecasting algorithm that fits, that learns from the past pattern of rents and then just forecast. Right? So the wires are actually the upper and lower bounds. Okay, but that's assuming there's no war, no pandemic, no interest rate increases, blah, blah, blah. So in the near term, okay, in the near term, if you use this, right, let's say this rate bar to forecast to the year 2023, this is it, the red line. Rents would have gone up by 11% next year, year on year. But because there's war and all the other stuff, after discussing with Ashley, I think we're going to see about 2% increase because you can see the downward pressure meeting the upside pressure. Right. So it's a 2% increase in gross rents next year, and is driven mainly by cost push pressure on the conservancy front, not because of, not really from ESG, but because of labor costs, etc., etc. So that's it for office.
Thank you, Alan. We'll take questions from the floor. Yes.
Alan, so if there's an increase in the carbon tax, will that affect a lot of the office rental? Based, just how I see your forecast.
Yeah. Our taxes are still pretty low, all the way to 227 to 230. So, but remember my taxes for grade AAA office building, this building here is single A. Double A would be UOB Plaza, Republic Plaza, triple A would be Asia Square. So triple A maybe adjust 3.5 cents per square feet more in the year 2027. Using $50 per ton, $50 Sing dollars per metric ton. If we go up to 85, then naturally you see more than a 50% increase, maybe to about 55 cents. But I've not included embedded carbon. That's something that's a bit difficult to measure. Yeah, I think embedded carbon and commuting carbon footprint for the staff would be something that will affect many companies' decisions. Not here, it's what their head office believes. Right? So we can't follow to say Singapore's ESG standards. We have to take the highest common factor that drives ESG standards, because our tenants are all multinationals, and then if UK has very high standards or Germany has very high standards, we must follow those standards because they will then make their own decisions accordingly. They have to comply. I think they don't just look at, I come to Singapore and I just comply with Singapore standards. I have to comply with my home standards too. And that's where the issues, the problems will start.
Yes.
You showed on the last graph that if we hadn't got the Ukraine war and the pandemic, the rental value would have been like
11%.
11%. What is the reason behind such increase?
Okay, if there'll be no interest rate increase,
Yeah, okay.
right? There'll be no economic, no recession. So if once you lift your brakes off these, once you have these brakes like recession, high interest rates, you probably see this. But if you don't, you go back to the era of quantitative easing, low interest rate environment, this decade, then the machine says, all right, it will go this way. It will go up 11%. So it's a black box. It's not really, it's a repeat of the past.
But there are other features or drivers like supply, stock, demand, or whatever that the machine learning considers. Okay, sorry then.
All right, because it's too long, so I cut it off at that point in time. You look at the supply numbers that we have, not a lot. Not a lot.
So there's an imbalance.
Yeah, so actually there is very little supply.
So that's why rents are rocketing.
Yeah, still going
would
up.
have been rocketing
If
no Ukraine war and no pandemic.
Yeah, if we have no supply, it will be like that. Because if there are periods in the past like 2015, 2012, right, 2019, no supply, and 2015, for example. Yeah, see, 2015, rent started to peak again. 2019, rent started to peak again when supply was very low back then. So the machine learns from these, it's a black box. You throw everything in, it comes out some answer. It's just a black box. And I think why I like that machine learning thing is because now we can contrast the past decade where we have these, an environment where interest rates are low, and basically interest rates are low. And now, when we have all these problems, what would happen? The machine would say, if there had been no, if you have gone back to the past 10 years, it would have gone up 11%. So some of our competitors maybe thought that it would go back to the past. So they are forecasting very high rental growth this year and next. But apparently it's not the case. But it only works for office rents. If you feed residential profile rents in residential rents or prices into this algorithm, it doesn't work because there's been too many interventions.
Greg, it looks like you got a question.
I guess it's quite a complex picture.
Yeah.
So the bottom line is OPEX and service charge is going through the roof as well.
Yeah. So rents are going to increase.
You're not actually getting real growth in terms of people.
Your base rent may not, you may not see increases in your base rent. In fact, you may see your base rent going down. But optically, gross rents, rents are going up.
Any other questions for Alan? Okay, if not, I've got a question. Yes,
Do you see supply going lower if more older buildings are
Yeah.
thinking of like retrofitting to kind of keep up with ESG requirements?
Okay. The two things about this older buildings. Okay, there are two stories to it, or rather one leads to another. So it starts like this. The grade B and grade C offices, those that you see down the street here, they're going to be hollowed out because they're not given green mark. So if you are a multinational company from Europe where you have high standards, I don't think you can move in those buildings. So you have to get to grade A. So grade A, especially grade AAA, is the closest you have to the best of the class. And that's where they like to go to, but because of cost constraints, they shrink flex space. So will they redevelop? The big question is, what's the future for the office space? They will start to think of it. Should I repurpose it to residential instead of offices? This is the issue. I think they will repurpose it to residential or mixed. They may not develop it. Now, they will end up in very bad dire straits because if they don't develop, the carbon tax on them is going to shoot through the roof because they're not efficient and the vacancies will be low. Right? So they're not going to collect enough rents to pay property taxes. There's no vacancy allowances here in Singapore for commercial buildings. And secondly, carbon emission is very high. So they will have to go and do something, fire and forget, build the resi, sell it off.
can you please thank both all